Well, what we all need going into this weekend is a bluffer's guide to the 2021 federal budget. G'day, welcome to Lunch Money, your online home for special situations, workouts and capital raising professionals. My name is Nick Samios. I am the director here and fund manager at Hermes Capital, and I am your Lunch Money host. So very well welcome, and thanks for joining us. Like I say, look, there's a lot of material obviously that flies around in budget week, lots of analysis, but the analysis tends to be from a lot of different points of view, from the consumer point of view, from mum and dad wage earner point of view. What I wanted to do today was to give us what I'm calling a bluffer's guide for small business advisors. If you're a finance broker, an accountant, a lawyer, or a small business owner yourself, what are the key takeouts of this budget, the stuff that you really need to know that's going to make a difference in your life? I've got two practitioners to help us walk through the budget, and we'll get to them in just a moment. And just a reminder to share, like, or subscribe to our podcast, or if you're watching us on YouTube, to help us reach more people and make the whole thing a lot more fun. Okay, well, without further ado, I am going to introduce our first guest today, and that's Gino Malacco. G'day, Gino. How are you?
Hi, Nick. How are you? Good. How are you?
Good indeed. So Gino is a tax partner at Hall Chadwick, and he wrote this, which is the Hall Chadwick's client guide to the budget, and it's quite detailed and succinct at the same time. I suppose it's a sort of a 14-page document, but I thought that since he'd obviously put a lot of his own personal effort and attention to it, then why not get him on to step us through it? But before we get onto that, Gino, what's been keeping you busy this week aside from putting together the budget guide?
Well, second Tuesday of May is about as exciting for accountants as what the first Tuesday of November is for most pundits. But the budget's obviously been keeping me busy this week. But also we've got tax lodgements due just around the corner. So that's been occupying quite a bit of my time.
So, and is that just normal sort of run-of-the-mill stuff? Is it any different this year to what it was last year?
I mean, in terms of the compliance area, there's it's pretty much what goes on every year around mid-May, early June. There's being the tax partner here, there's been a lot of other things that we've been working on as well, including there's been some class rulings that we've been doing with the tax office and trying to get to the bottom of negotiations with that. And they've been progressing quite well. We've had good results on some of those, and we're still working on some others. So it has been a pretty busy time for the last couple of weeks, and especially the last week.
And how does it work there within Hall Chadwick? Obviously, you've got a lot of partners. I
Yes.
mean, are you the sort of the in-house tax specialist, or I suppose all accountants have to. Yeah.
Yeah, I am the in-house tax specialist, or one of, but the primary one in the firm. So I deal with a lot of the external matters for clients, negotiations, as I said, negotiations with the ATO, class rulings, private rulings, as well as taxation opinions and taxation advice. So anything that goes outside the ordinary normally comes across my desk or my team's desk, and it filters through me.
And so you'd be talking to the tax office fairly regularly?
On different matters, yeah. I mean, the last couple of weeks I've been talking to them very regularly for the class ruling I've been working on, as well as getting an objection over the line for another client. So, I mean, sometimes you can go quite a long time without necessarily talking to them, and other times you're speaking to them on a regular basis. Just
to sort of dumb down the class ruling for people that don't know what a class ruling is, just explain that briefly.
Sure. Class ruling normally affects, as the name suggests, a class of taxpayer. In this case here, it's all of the shareholders of a particular company. So rather than every single shareholder of a company actually making an application to the Commissioner of Taxation in terms of the tax aspect of a particular transaction, the company can do it on behalf of all of the relevant shareholders. similar to, I guess, a class action for litigation purposes, where there's a couple of people who represent, or the lawyers who represent a class of taxpayer, and anyone within that class is bound by or can rely upon that particular ruling. So we're trying to get one of those over the line at the moment.
So I suppose, with a new budget, quite potentially there could be certain interpretations that you want to go, that could evolve out of this, that where you need to apply for those sorts of things.
Normally, if it's affecting a particular taxpayer, then you would normally only go for a private ruling.
Right.
And a class ruling is more, for example, we've got a company that's going through a distribution of funds from the company to its shareholders, and the company wants to ensure that all shareholders have got certainty in terms of the tax aspect of how that distribution is going to come out, whether it's assessable or part assessable, or it's a return of capital. And so the tax office can give those shareholders certainty in terms of how that distribution is going to be treated. The company is actually applying for a class ruling in relation to that distribution. So all shareholders can then rely upon that ruling and not have the fear of the tax office treating that distribution in a different manner.
Okay, but you get a lot of private rulings as well.
Yeah, we do, and that affects a particular taxpayer as opposed to a broad range of taxpayers.
Okay. All right, listen, we will pop you in our waiting room, and
Sure.
We'll just introduce our next guest, David Gandolfo. G'day, David. How are you?
Very well. How are you going?
Very well indeed. Now, David.
Afternoon.
It is afternoon, actually, yeah. David doesn't necessarily need introduction to many of our viewers or our regular viewers, that's for sure. But, David, you're now the chair of Advocacy at CAFBA, as well as holding down a day job as a partner at Quantum Business Finance. You've been doing a bit of travelling this week.
I have. I was in Canberra the other night for the federal budget. Went to the budget dinner, and to which the Prime Minister and Treasurer spoke. And this morning I was at another breakfast where the Treasurer was speaking, and had an opportunity to ask some questions there. And we also at CAFBA at the moment are in the middle of our PD, or product professional development day series, which is right around Australia. We've just concluded the East Coast, so I was in Sydney during the week as well, and we're off to Adelaide and Perth in the week after next.
Wow, that's with professional development, all that sort of stuff.
Yes.
And that that's CAFBA, which is obviously the Commercial Asset Finance Brokers Association, which is the peak body for equipment finance brokers and business finance brokers more generally. And what about in your day job, the one that actually puts food on the table?
Well, it's been a fascinating year. I mean, obviously, no one don't need to describe what a year it's been, but I can tell you that it's coming back. And we provide finance to small to medium-sized businesses. And our April figures were better than pre-COVID April figures. So even though we had a terrible year last year, and it was very challenging, not just in the demand for finance side, but the supply side as well. And there is still a problem with the supply side in terms of earth-moving assets and vehicles and new equipment. There's also a bit of a logjam in the banking system in access to credit, which we can talk about, and for which CAFBA advocates. But on the demand side, people are very, very confident. Interest rates are very, very low, and there's incentives, and some of them have been extended in the budget. So people are out there spending money, the businesses that did get through COVID, and there's a great deal of confidence out there, which is fantastic.
Yeah, I must say that our pipeline is definitely it's much larger in the last couple of weeks than it's been historically. So there's a lot more inquiry, a lot more people seem to be doing stuff. And I know that in your space, I know that's interesting what you said about April being higher than pre-COVID, and you're not the first broker that's told me that. So that's interesting. And now the other thing is, when you and I used to work together 30 years ago, David, believe it or not, actually I met a broker that you and I had done a bit of work with 30 years ago. I'll tell you another time, but this week. But we didn't have this thing called file pickup time. But that's now become a sort of a metric within the banks as to how long it's going to take before they pick up a file. That's something that you guys are working on?
Yeah, and look, to their credit, all the banks are working through that, and it's been a consequence. It's not their fault, not of their doing, but it's been a consequence of more regulation and more processes that they need to go through, and verification, anti-money laundering processes, and things like know your customer, those sorts of processes. And they've had the same problem that we've had. You've had people working from home that would normally work in teams, and where they can normally workshop an issue or a problem between them, or there's always someone to ask if there's something they come up against. They can't do that if they're working from home, and they kind of hesitate. So it's not that they're not working on it, but the whole process has been terribly disjointed. And we are certainly very, very keen to get everyone here at Quantum Business Finance back into the office, and we've mostly got that. And we've got capacity to do things from home that we didn't have previously. But we're really, really keen for the banks to get everybody back on board and have them and have that continuity of flow of work, so they do pick up files quickly. I know that in the residential mortgage space, my colleagues and friends in the MFAA are working very, very hard with the banks there, and in the resi mortgage space, I know it has become a bigger issue than it is in ours. But certainly, turnaround times on loan approvals and on settlements, they were terrible during COVID, but they're coming right back, and they're actually getting close to reasonably normal times now. Last year, around June, we had a real issue with people wanting to claim the instant asset write-off and literally missing the deadline, the June 30 deadline, if they didn't have things in by, say, 10th or 13th of June.
Yeah, I guess one of the issues in banking, in particular, particularly when you look at interest rates as being as low as they are, I guess one of the major costs in providing finance is people. And I suppose they've got to balance throwing more people at all of this compliance, or otherwise just things are going to take longer to keep the pricing down. It's obviously a hyper-competitive environment, and I'm sure that comes into it as well. Listen, we will bring Gino back.
Hi, David.
Gino, how are you? Nice to see you.
Nice seeing you.
Now Gino is our panel expert today. So he's the guide, and David, well, certainly I'm one of the bluffers. Maybe David's sort of halfway in between, I'm not sure. But so Gino, I thought what we might do is just step through your guide, and you can sort of fill out a little bit about it, and
Sure.
David can sort of give his perspective from a commercial finance broker's point of view. There's a couple of things. Starting off, there's a couple of tax and superannuation highlights. When it comes to the tax breaks, we'll talk about accelerated write-off in a moment, but leaving that aside, anything sort of that small business people should be particularly interested in when it comes to tax and super?
Well, I guess there's a lot of things in there which affects them as owners. So not so much from running a small business, but just being a individual who pays income tax. There is that extension of the low and middle income tax offset, which I know everyone has always been quite happy about getting an extra $1,000 in their refund if they're within the income limits. So that's had an extension, which is great, which gives more people, particularly at that level, that they do spend most of the money that they earn, some additional monies to actually spend. So that's obviously a positive thing. In terms of some of the minor things that impact on business, the removal of the $450 monthly limit where superannuation kicks in will probably impact some businesses, particularly owners of businesses that may actually pay under a certain limit to actually avoid super, or if they've got casuals in their business that earn less than $450 a month, and they were getting away with not paying any superannuation, that's obviously going to impact on them. And the penalties in actually not complying with superannuation guarantee obligations are quite draconian. So they want to make sure that when that new legislation does kick in, that they do actually put their systems in place. Thankfully, a lot of the payroll system uses what guides most employers, but that's obviously quite important for them to actually get their housekeeping right going forward, so that they do pay super on all wages. So
that's really that $450 thing. I guess helps them stop treading on any sort of admin landmines that suddenly incur penalties over
Yes.
over really trifling amounts. Just before we turn the page on this guide, is there anything in there? A lot of people, every year there's small business people that are looking to retire and sell their businesses. Is there anything in there affecting people, either in the income tax or capital gains or superannuation, affecting decisions for people selling their businesses?
Well, in terms of superannuation contribution, one of the positive aspects of this budget is that people can actually continue to contribute into superannuation even if they don't make the work test. Up until now, there's always been a work test for contributions made over recently 65, but now over 67 up until the age of 74. So to actually make a contribution into superannuation, you actually had to satisfy the work test. So what the government has announced in the budget is a removal of that. So people who actually do sell businesses or actually have monies that come to them after the age of 67 when they do cease employment and they no longer satisfy the work test, they will still be eligible to actually contribute monies into superannuation, which I think is a great benefit, especially given the fact that you can then access the super basically almost straight away. So that's a very welcome inclusion within this budget.
Okay. David, sort of before we move on to the other areas, anything in there about personal tax or super that you think is particularly of interest to your clients?
Well, I'm happy for Gino to be the expert because my PI cover doesn't cover me for talking about tax. But one of the immediate thing for the $450 exclusion on superannuation guarantee or removal of that exemption, it's going to be a pain point for a lot of small businesses, particularly who have got casuals, and you think of Baker's Delights and places like that. But I also know that largely those taxpayers or those workers are often women, and they're certainly often students, and everybody should be able to access it or gain superannuation on every hour of work that they do. So I know that it's a problem. I'm on the board of, I'm actually a past board member of COSBO, the Council of Small Business, but I'm certainly very active in that board, and there's been a lot of discussion around that table about the benefit or otherwise of the removal of that thing. But ultimately, I think it's a good thing for the end user.
Okay, and you and I were talking a little bit earlier. Obviously, the home builder has been extended. You and I aren't necessarily in the home loan business, but nonetheless, one of Gino's comments here in his report was that one of the reasons they're extending this, or maybe even the key reason, is to support jobs in residential construction sector. So I'm sure you'd be financing plenty of tradies and their utes and their diggers and all sorts. So
yeah, it's certainly the home builder scheme is very, very positive. Because, as you say, we're not in the resi finance space, but we're certainly funding businesses that build those properties. And there's also in the infrastructure space, there's $15 billion in road, rail, and infrastructure projects that are ongoing in the budget. So it's those projects, and that's actually what's helped us, I think, in that throughout this period, when it was clear that we were going to head into a recession, it was also fairly clear that we're going to head out of it fairly quickly because of all the infrastructure projects that are on at the moment. Home builder adds to that and helps that. So it's not like previous recessions where there was no money around or interest rates were high. There's tons of money around and interest rates are low and there's plenty of work on.
Yeah, well, there's plenty of money around, all right. Okay, all right. Well, let's move on to Gino's report. Well, before I do that, anything on home builder that you want to sort of throw in there? 10 cents worth, Gino?
Yeah, I mean, the good thing about home builder, I mean, the government knows that there's a lot of people who have actually saved up quite a bit of money during the pandemic, and as a mechanism to try and get people to actually put their hands in their pocket and actually start, supporting jobs. The home builder or the home ownership funding package is actually quite beneficial for that. But it also links in, and I know we're going to speak about the instant asset write-off. But the other thing is also the loss carryback rules, and that you can have a lot of these tradies who can go out and buy an asset and fully depreciate that, and to the extent that they're in a company, a lot of people have corporatised their businesses. if they go out and get another couple of utes to support a couple of extra employees to help with the building boom, which everyone's expecting with this, and that creates a loss in a particular year because you've got that benefit of the instant asset write-off, you can actually pass that loss back to
let's deal with these one at a time. So we'll start off with the extension to temporary full expensing, which is what you've put that in your report as. So
Sure.
So you've just a quick recap of what you just said there, what that actually is. So this is the 100% tax write-off.
Yeah. So essentially, and we're talking about almost every single Australian business being able to qualify, except for the very large ones. The threshold is $5 billion in turnover. So I would think most people who are watching this program would fall within that category.
Yep.
And essentially, it just allows a straight 100% write-off of an asset. So if you go out and you buy yourself a Bobcat and it costs you $150,000, then you get a $150,000 tax deduction straight away. Similarly, if you go out there and you're buying yourself a ute for $40,000 or 2 utes, if you've got 2 new employees and you're spending $80,000 on that, you get an instant deduction rather than having to claim the depreciation over, what is normally a 5 or even a 10-year period for a lot of these types of assets. You get the benefit of actually getting 100% depreciation in the year of acquisition.
Well, finance brokers certainly love all that, and I'm sure that, David, I'd be pretty surprised if you hadn't been lobbying for an extension to that. And of course, we were saying before, that's assuming you can get your hands on utes. But what are your thoughts on this?
We had it in our pre-budget submission, which we lodged in January, and it was in previous pre-budget submissions as well. It's not just the extension of the instant asset write-off that we've asked for. We want a permanent investment allowance. And in fact, at the last election, we supported Labor on their investment guarantee. But it's not just that. Every 12 months, every budget, the Treasurer announces an extension to instant asset write-off or a scheme like this for another 12 months. What we'd really like is to have that scheme in place for the next 3 years. And in this instance, we know that it's out to 2023. But in normal circumstances, we want it out to 3 years. And then if they want to make a good announcement every 12 months, perhaps they can extend it beyond that period. Each subsequent budget. But there is an anomaly, though, which I might just point out. We have raised this with Treasury, that it doesn't extend to hire companies. There is an exemption for hire companies. And if you run a private business, and what it's intended is for the big hire companies not to claim the asset write-off in full. But if you run a business where you've got a structure of a trading entity and a holding entity, and the holding entity owns the assets and leases them across to the trading entity, you may not get the deduction in that instance, and you've got to buy your assets in your trading entity. We've raised that with Treasury, and they're looking at it.
Wow, that's yeah. I mean, a lot of companies structure themselves that way, don't they? You've got the asset holding entity and the trading entity.
I wouldn't know necessarily that's in there.
Wow. Yeah, I hadn't thought about it. There are a few tricks. Before we came on air, we were talking about when we should downsize our homes. We've got to wait till our wives hit 60 and all that sort of stuff. There's a couple of little tricks. I guess that's why Gino earns all the big bucks. All right. Well, coming on to the next one, we've got extension of temporary loss carry back offset. So, do you want to just explain that to us, Gino?
Yeah, sure. I mean, the loss carryback offset was put in place essentially during the COVID period, so that companies could carry back losses that they were expecting companies to incur during the pandemic and in the period after, and allow that loss to be, rather than just carried forward to be used against future profits, to actually carry that back and offset it against profits that the company has made in prior years. So essentially, we've just completed the 2020 financial year, and we're almost completing the 2021 financial year, both of which have been particularly impacted at various times for a lot of people, particularly in the tourism, hospitality industry, by COVID restrictions. So to the extent that they're incurring losses in these years, and they've made profits in the 2019 financial year, they can then carry that back and recoup some of that tax that they've paid in the 2019 financial year.
Okay.
The budget measures that they've put in place is to extend that by a further year. So essentially, any losses that have been generated or made in the 20, 21 or 22 and 23 financial year can be used to offset any income tax that's been paid in the 19 financial year onwards. So if you've made a profit in the 20 financial year but a loss in the 23 financial year and you've broken even in the middle, then you can use your loss in the 23 financial year and carry that back and recoup the income tax that you've paid in the 19 and 20 financial year. So extending that out by an extra year gives companies the ability to claw back some income tax that otherwise they would have to wait until future profits to actually generate. So that's it's a positive measure. And when you actually couple that with the instant asset write-off, you can have a company that would have otherwise have made for example, a $200,000 profit in the 2021 financial year. They've invested in $300,000 worth of equipment purchases that gets the instant asset write-off. They can actually generate a $100,000 loss in that year, and they can use that to actually recoup some of the income tax that they've paid in prior years. So
they're not missing out on any of the benefit.
That's exactly right. So I mean, the two actually work very well together in actually allowing companies to go out there, and particularly if they're in a good position or they're benefiting from post-COVID booms, such as the housing sectors, then you can actually go back and recoup some prior year profits and actually generate some losses by using the instant asset write-off provisions.
All right. David, I can just see brokers all around the country selling losses to the bankers, saying, the loss is a good thing because we're going to carry it back.
Well, if you understand credit properly and you don't just look at the profit and loss at the bottom line, you actually understand cash flow, then there's nothing wrong with it. It's fine. I actually think it generates a question to Gino. If you're going to have companies that have depreciated assets or written off assets that would otherwise have been carried on the balance sheet, so you're going to write down the value of businesses. Is there going to be a kicker at the other end of this, where you sell your business and there's going to be a huge capital gain, or does it have a future tax cost by taking advantage of these schemes at the moment? And I would also say that before you answer that, it just goes to show that there's literally nothing left in monetary policy. It's exhausted, and all the stimulus is fiscal policy, which is fine, but it just means that it's a little bit artificial. I'm just wondering what the future consequence of it will be.
Well, let's not answer. If you can answer the question, we'll get to the philosophical stuff in a minute.
David's right. There is that sting in the tail. I mean, if you're buying an asset and you turn around and you've got zero tax cost on that asset, then essentially all of the sale proceeds are going to be subject to income tax when you sell. Now,
right.
That is the flip side of the equation. But in terms of stimulation, which is what the government is trying to do, you're buying an asset, and most businesses would buy an asset and then hold on to it for a period of time to get the economic benefit of actually acquiring it. I mean, you wouldn't go out there purely to buy an asset to get the tax deduction, because that's not smart business. You're talking people who would be smart in business, who would otherwise be looking at investing, and they would hold on to those particular assets for a period of time. And in a lot of cases, you've got a tradie that thrashes a ute, you're not going to get much for it at the end of the day anyway.
That's right. It would otherwise have been written off, but it is a question that we get from clients quite often, because they're getting these immediate deductions. And I can promise you, or guarantee you, in my many years of doing this, that low interest rates are they're good, but tax treatment is the biggest incentive, and it motivates people to upgrade assets and alter them. And you're not going to buy something just because you can get a deduction on it, but if you're thinking about it, there's an incentive, particularly as each financial year rolls around. If you've got a profit that's on which you're going to pay tax, and there is the ability to acquire a new asset, increase your throughput capacity, and reduce your tax, people do it.
Yeah.
Okay.
That's exactly
Well,
right.
it's very interesting about the sting in the tail, of course, because as you say, you're basically 100% depreciating the asset. So I guess whatever you sell it for is all capital gain virtually, isn't it? So, all right. Well, look, Sule has preempted our next bit. He said, budget extended powers of AAT to pause or modify ATO debt recovery, another hit delay for the insolvency profession. So our liquidator friends are obviously concerned that no one seems to be thinking about them in any government policy setting. But that does bring us, thank you very much for pointing that out, Sule. That is a lovely little segue into our next headline here, extended powers for the Administrative Appeals Tribunal to pause or modify ATO debt recovery. So what does that mean, Gino?
Yeah, I mean it's targeted for the smaller end of the market, because there is a aggregated turnover threshold limit of $10 million. On being able to access that. But if you do fall within that particular area, SME area, then essentially small businesses will actually be able to apply to the AAT to actually pause the ATO debt recovery process. So if there's a genuine dispute about an actual debt, tax office debt, then rather than dragging it through the courts and being subject to potential liquidation in terms of not paying an assessment, then the small businesses will be able to actually grant or be able to access a stay in terms of that through the AAT.
So small businesses will be able to better manage their tax debt.
Yeah, I mean, if there's a dispute in relation to a tax debt, rather than getting the lawyers involved and then having a potential of threat of liquidation going over your head, because the tax office, if you've got the ability that if there is a valid assessment out there, then they've got the right to call upon that debt and bring in liquidators if necessary. But
so this applies to disputes or just to tax debt generally?
It's for debts being disputed.
Disputed, yeah, okay. So it's not. So Sule doesn't need to get too downhearted about it. It's only disputed debts. It's not necessarily if you've accumulated, you haven't paid your PAYG for 6 months. There's no dispute around that. And so,
yes,
okay. Okay. Well, the glass is half full there, Sule. So don't despair too much. And now, David, we were talking a bit earlier. I know that at one stage, I think either with COSBA or CAFBA, you had arranged a bit of a powwow with was it Josh Frydenberg and the banks around trying to get them to better understand tax arrears and not that it necessarily isn't the bogeyman.
We did get Josh together with the banks. One thing the CAFBA has been very good at, if you have a conversation with government and they're saying one thing and you have a conversation with the banks and they're saying something else, then we put them all in the same room, and it's amazing how that conversation starts to work out. But we did. It wasn't Josh on the tax front. It was Deb Jenkins, Deputy Commissioner of Tax at the time for small business. And our view, and I'm very much on the side of the tax office with this, there's loads of businesses. We have tons of clients who have tax arrangements. And it's not because they can't pay their tax. It's because it's a fairly cash flow effective way of paying your tax over time, particularly during a pandemic when you're looking into the abyss, and a lot of arrangements were entered into prior to JobKeeper and no one knew quite where things were headed. But unfortunately, banks and lenders collectively take a very, very dim view of tax debt. And I think that's a legacy thing from perhaps previous governments, and that misconception that the tax office ranks ahead of other creditors, and that hasn't been the case for a couple of decades. But we did get them all together. I can tell you that in any given year prior to COVID, there are 800,000 tax arrangements that are entered into. There's about 600,000 of them that are current at any given time, and there are less than 2,000 that end up in dispute. So it's not exactly a high risk to, shore up your cash position and hang on to cash that you would otherwise be giving to the tax office and you can't get back at a fairly low interest rate if there is interest charged, rather than going to another bank or extending your overdraft and diminishing your cash reserves. So it's a strong argument. It's an argument of ours, and it's a policy of ours that, and we can't unfortunately change bank thinking and bank lending, but we do try to do that in terms of their attitude to tax debt. But the one thing I would say is, in the current environment, taking on a tax arrangement is like a cancer on your credit report, and it stands out on your balance sheet. Lenders look for tax portals, and what they're looking for is interest that you've paid to the ATO. Why was that? So you actually are, in fact, better off to perhaps not take the arrangement with the ATO, but to take it elsewhere.
Yeah, I guess it is a bit of a double-edged sword. All right. Just any sort of further comments on those tax arrangements? Again, not where there's disputes. I understand, Gino, that obviously you're sort of involved with taxpayers, as people who are making a lot of money and are looking to find to make sure they're interpreting the tax laws correctly. But do you get involved where there's people in arrears and are trying to manage their debt?
Yeah, I mean, we deal with the tax office. I mean, for example, anyone who lodges an objection is disputing a tax debt.
Yep.
So those sorts of things do come about, even in companies that are actually quite prosperous and are making money. So it's one of those genuine things that will assist. As I said, you do need to be a small business to actually fall within the recovery powers or the pause under 10 million. And for a lot of those taxpayers, as David said, some of those things for clients can be quite daunting. They hate dealing with the tax office. They hate going through the litigation process. It can be quite expensive and quite costly for them. AAT is a cheaper version rather than going through the courts, but it does actually give them some sort of comfort to know that they're not going to be, have a liquidator or someone appointed whilst they do have a genuine dispute going on with the tax office.
Okay. All right, listen, we're beginning to run out of time. So just very quickly, we've got fuel tax credits, heavy vehicle road user charges increased. Now, very quickly, what does that mean, Gino?
Yeah, well, a lot of heavy road users or primary production people do actually get a credit on their fuel tax. It's a way of lowering the costs. It's fairly specific in terms of being able to access the eligibility rules for fuel tax credits, but the increase in the fuel tax credit rebate will come as a welcome thing for a lot of businesses that do rely on that money coming back.
Okay. And David, brokers love financing stuff that drinks fuel. So any thoughts there? Does that make a difference to your day-to-day or to your clients?
It doesn't make a difference to the day-to-day, no. But anything that changes their operating cost or has some kind of impact on us. But no, it's very much downstream from. Well, it's not within our regular line of sight.
Yeah. Okay. All right. Well, look, none of us, I don't think any of us are macro economists, but let's just sort of by way of closing, let's just get a little bit philosophical. There's when you look at the budget last year, where they thought they were going to be versus where the budget is this year, there's a $104 billion improvement. So there are 100. If you get that, so where they thought they were going to be as to where there's $104 billion windfall, if you want to call it that. 6% of that they're spending this financial year, 77% next financial year. So they're more or less handing that windfall back. David, you made the comment before about fiscal policy. I mean, when we were kids learning economics at school, it was fiscal policy or monetary policy. But of course, these days we have money printing, MMT. Are you worried about? Thank you very much for your comment there, Chris Arnold, a long-term friend of Lunch Money and personally as well. Are you concerned, David, about? Is anyone talking about inflation? If there's inflation, you think interest rates are going to go up? We were saying before, iron ore in the budget is at $55. The spot price at the moment is well over $200. Brokers are forecasting $100, so there's a bit of give there. What are your thoughts generally at a macro level? And we'll do that by way of closing, and then I'll come to you, Gino.
Right. There's a couple of points there. The iron ore price, I mean, that's going to provide some headroom if it doesn't actually sink to that $55 level, which will be good. One of the things that stuck out to me the other night in the budget is that it's going to get deficit will get to $1 trillion. And I know that interest rates are historically low, and we're going to pay less in interest than we did in the early 90s for the borrowings that we took up then in that recession. But we're going to have $1 trillion in debt, and I don't know what the time frame is for actually repaying that. And one would hope that we turn this around reasonably quickly so that can be repaid. But because there's so much liquidity in the market, and particularly from the US, there's talk there of increasing interest rates. And whilst we don't have a domestic requirement to increase interest rates, and the Reserve Bank governor has said that that's not on the cards, if it starts to happen overseas by the nature of international markets, that will have to start to happen here. So if we've even 100 basis point increase is going to hurt some people who have forecast and budgeted on interest rates that are historically low.
Yeah, well, David, you and I met each other and worked together in the recession that we had to have, the annus horribilis, as the Queen described it. And we saw really high interest rates. If you're borrowing for your home at 2.5%, and that's going to go to 3.5%, that's a significant increase. What do you think, Gino, philosophically there? Is this debt insurmountable? Are you worried about interest rates for inflation?
Well, the amount of money that we're going to go into deficit, as David said, it is going to be basically $1 trillion. It ultimately needs to be paid back, and so, but that is in the future. Interest rates can't stay at the historical low rates forever. I think everyone understands that. But there will always be a shock in the tail when those interest rates do start going back up again. We saw it was only 2 nights ago the Dow dropped, I think, 2% because there was interest rate fears on inflation. So inevitably it will happen here as well. We do have to pay back the debt, so taxes will probably need to rise, or collections, as a proportion of GDP will need to rise to pay that back. But the focus at the moment is, whether it's because there is an election around the corner or not, but the focus is to make sure people have got jobs. People have got jobs, then people start paying income taxes, and people start spending. They consume, and they kick in GST and everything else like that. So it's one of those things. Sometimes you need to spend the money to actually get the economy kicking, so that the tax receipts can just can flow on from that. One thing we don't want to be is a position like Europe, for example, where you've got historic debts as a percentage of GDP. Unemployment is considerably high, and you've got negative interest rates because no one is spending any money. So I think Australia is very well placed in relation to our economy, that we will be driving unemployment down, but I think inevitably there will be that interest rate rise because inflation won't stay at its current levels, and it's not designed to necessarily stay at such low levels, and it's something that we will need to deal with in the future.
Okay, yeah, look, I guess these days, again, when we were all at school, I guess we were learning, Keynes and monetary theory and all that sort of stuff. These days they're teaching MMT, and under MMT, deficits just don't matter at all. But I still don't quite understand all of that. But listen, I reckon that between the two of you, I'm not going to give myself any credit, but we have delivered just such a punchy guide for small business owners. We've sorted through all the palaver. We've done it without any boring graphs. So this was indeed the Bluffer's Guide. But if you want a little bit more meat on the bones, you've got Gino's Hall Chadwick guide there. And I'm going to, if you don't mind, Gino, in when I do the LinkedIn summary of today, I'll put a link to that, and so people can go there to see that. David Gandolfo, thank you very much once again for coming on Lunch Money. Gino, thank you so much for making your debut and helping us out.
Not a problem.
Always a pleasure.
All right. Well, thank you to everybody who's been watching. We'll do it all again next week. Don't forget to share, like, or subscribe. See you later.